Okay, so another FHA non-retention option is the pre-foreclosure sale or FHA short sale. Um, HUD typically waives the right to a deficiency judgment. HUD approval is required. The contract must be signed within 4 months of the approval in terms of the contract to purchase the property. The borrower must be at least 31 days delinquent. There cannot be any junior liens, and then the net sales proceeds are going to go to HUD. FHA deed in lieu. This operates just like the deed in lieus we discussed before. Titles transferred from the borrower to HUD. The home must first be offered for sale through the pre-foreclosure sale process, so they got to try a short sale first. There can be no tenants unless HUD approves the tenants. No junior liens, and that includes IRS liens. If you see some federal or state tax liens on the property, a deed in lieu is not going to work in the FHA context. Okay, now we're going to move on to VA guaranteed loans. So if someone has a Department of Veterans Affairs loan, these are the options for them. They have repayment plans, and I'll just say that VA is very similar to FHA in terms of the programs that they offer. So when you're comparing the two, you're not going to see a whole lot of differences. So VA has repayment plans. They've got forbearance type agreements. They have a modification agreement where they will extend the loan term without doing an NPV analysis. They can do refinances up to 100% loan to value, and then refunding can occur where the VA buys back and services the loan in default in special circumstances. Pay particular attention to that in situations where somebody may be denied for a workout option, but they're very, very close in terms of getting an approval. If they contact the VA directly, they may have some luck in trying to get a refunding to occur. And then non-retention options, they have something called a compromise claim, which operates pretty much like a short sale. And if the proceeds of the sale are insufficient to pay the loan balance, the VA will pay the buyer the deficiency in order to facilitate the sale. So it's kind of unique in that regard. But otherwise, it's basically like a normal short sale. They do have a deed in lieu option, and then of course they do have times where they allow for assumption agreements as well. VA also has a HAMP style modification using the standard HAMP guidelines. However, again, just like FHA, there's no NPV test in VA's version of HAMP, and then the loan must be at least a year old. Rural Housing Service direct loans, they offer interest credit and payment assistance. They can subsidize the interest. They can give a payment moratorium. They have a delinquency workout agreement, which is like a repayment plan. They can do protective advances where they advance funds to cover the taxes and the insurance. They can be fairly unique. If there are quite a few of these in your area, you may want to invest more time in learning the specifics about these RHS direct loans in terms of how specialized their options can be. Section 502 loans, they can also have repayment agreements, special forbearances, modifications, short sales, deed in lieu, and then a version of HAMP as well. Rural Housing Service version of HAMP, it's when a borrower is in default or facing imminent default, and the back-end ratio cannot exceed 55%, and it includes a trial payment plan, which afterwards then they reduce the interest rate and can extend the loan up to 40 years. And then there is something called a mortgage recovery advance, which basically operates similarly to a partial claim that RHS HAMP also can offer. You're going to want to review the agency contact list on page 31. in terms of who to call if you have questions about servicing of a loan or just about particular servicing guidelines in general. There are some great resources there for you. So take a look at that page. Maybe mark it with, with a post-it or something like that, so that you can refer quickly to it. And then you're going to want to look next to federal, state, and industry-led programs. Their FDIC had something called Mod in a Box, which was a first kind of across-the-board modification program. Then there are your state hardest hit funds. There were 18 states that were designated as hardest hit by the foreclosure crisis, and they were given most of them were given a significant amount of money through the Treasury Department in order to help unemployed borrowers either bring their loan current after a period of unemployment and then reemployment, or bring them current and make payments on their behalf until the assistance runs out. And then usually in most states that offer those types of programs, it's a forgivable second mortgage. So the borrower gets the upfront assistance, and then so long as they remain in the property, it's forgivable over a period of years. Some states spent that money better than others. Some of them spent it really quickly, some would say too quickly, and other states are still spending it. So just make sure you know if it's still available in your state and how to go about applying for it. And then there also are state initiatives like state mediation programs, where basically the borrower can meet with the lender in a court-ordered mediation and try and do some type of workout agreement. There are state housing finance authority refinance products, state and municipal rescue funds. You're going to want to keep abreast of changes in state foreclosure laws, and get yourself familiar with the Hope Loan Port, and see if that's a tool for you that may work better for you in terms of communicating directly with servicers when you're submitting workout packages. Just briefly on the national mortgage settlement, it involved 49 states, that's right. Oklahoma decided to abstain, but it was effective April 5th, 2012. You've heard me reference it a couple times, but basically involved the top 5 mortgage servicers: Citi, Wells, Chase, formerly Ally, formerly GMAC, and then Bank of America. And the relief had to have been completed by February 28th, 2015, but as you see in the note there, all 5 banks have already completed the relief that they were required to complete. So you're not going to hear a whole lot more about this, other than just keep in mind that the national mortgage settlement was important in the sense that it recognized that these big top 5 servicers were in a lot of ways performing very poorly in the realm of servicing loans that were in default, and so it created a lot of rules that we now see that have been either enacted directly or modified or supplanted in the new CFPB regulations. So it was, although the assistance has dried up through the settlement, it's started a larger conversation that's continued today. And just a brief snippet too, in case you do run across a bank who still is offering modifications under the 2012 settlement. Servicers do have to notify borrowers if there's a workout option available for them under that settlement, and then they have to evaluate all borrowers for modification before referral to foreclosure, and you only get one bite at the apple with your application on that. Fannie, Freddie, FHA, and V loans were not eligible, so these were basically mostly conventional loans. If you had somebody with an FHA loan during that time period, they wouldn't have even been eligible for one of these national mortgage settlement modifications. They did offer principal reductions. They usually would solicited borrowers directly, on whether or not they could qualify, and then of course in March 2014, the settlement monitor reported that the banks had satisfied their consumer relief and refinance obligations pursuant to the settlement. So probably not going to be hearing a whole lot more about it. You just need to be aware of its existence. And I'm going to skip past the loan modifications and refinances through the National Mortgage Settlement just because it has ended. So that is the end of section 3.4 on whether the client can apply for other programs.